Welcome to the Daily Update. This is Being Prepared Friday, April 1st, where we'll talk about the action in the market today and then see how things look for Monday, April 4th. And things are turning a little bit more negative. If you're really bullish about things right now, if you want to see things go higher, we're seeing some weakness. Even though we had an up day on Friday, the damage of the previous 2 days is kind of starting to bleed into things. Doesn't mean that we're turning full-blown negative. It just means that we're weakening. And if we want to see prices go higher with any kind of conviction, we're going to need to see some buying coming in. Okay, so what happened on Friday? We did have a slightly higher open. The big employment report came out, and that's usually a big deal. But it seems like everything is a big deal these days. And sometimes the markets focus on an economic report, they focus on a geopolitical event, they focus on what's happening within the economy. And it seems like we're being bombarded with a lot of different things and some contradictory things right now. Some are saying, yeah, things going to be okay in the future. Other things are like, well, we better really be careful here. We've got some bad things happening. And when you're in that kind of a tug of war, regardless of what your opinions are on things, you're a little indecisive, and we're still seeing that in the market. So if you're in the market already and you are indecisive, that means that you probably sell, because most people are long in the market. So we saw immediate selling, and it took prices negative right away. So the positive open kind of went away. It was still in the backdrop and it still helped things, but we saw some selling right off the bat. There was an attempt at a bounce, but that failed. And then prices ended up falling a little further down to S1. As the day went on, there was a rebound, and this was pretty positive. We went all the way down. We were dancing around S1, and we saw a rebound from that level, and we actually went into positive territory. But then there was some late day weakness. However, there was some buying going right into the close, and that really helped to salvage the day, if you will, if you're more positive on things. We ended up being up 0.34%. The volume was below average, and we're still seeing declining volume overall. You've got a lot of folks that just don't know what to do right now. The technicals, they're still positive overall, but we're seeing some weakness, and I'll go through that with the different charts here. We're still dealing with earnings on a case-by-case basis. We're still really battling with inflation and interest rates. We're seeing interest rates continue to advance. They were up pretty strong on Friday. There's a lot of inflationary things happening right now, not only on an economic scale, but you're probably feeling it on a personal level as well. And then we have our geopolitical concerns. What's going on between Russia and Ukraine? What's happening with the relationship between Russia and the US, and the US and China, and in the Middle East, and a lot of different things that are happening there. One thing from an economic standpoint, and what investors are really focused on, is the inverted yield curves that we're seeing. And I have some charts where I'll show that. And then the different oil supply issues. The administration has decided to go ahead and tap into the oil reserves, which may sound great and wonderful, but is that really going to make a difference? It might lower things a few cents. Other people say, yeah, it's what we need to do. It's going to really have a big impact on having oil prices go down. We'll just have to see how that goes. There's another side of the coin that says, wait a minute, that's meant for emergencies only, like a fire extinguisher, or use this idea when you have to break the glass first to get to this idea. That what happens if we deplete a lot of our oil supplies? And it's not like we're having a big party with the rest of the world right now. There's a lot of geopolitical tension going on. And if those oil supplies are depleted and we find ourselves in a pretty hefty kind of military situation, that could really harm us. Because why do we even have these reserves in the first place? It was because of World War II. We got caught off guard. the one saving grace, if you will, to Pearl Harbor was when they bombed Pearl Harbor, they were not able to blow up our oil supplies there. And that was bigger than a lot of people realize. And we don't want to be caught in that kind of a situation again. So that if we have some real catastrophe where we've got to get to our oil, we want to make sure that we have oil to get to. And is this the best use right now for trying to help the short-term situation with high oil prices? Is that going to hurt us somewhere down the line? I'm not coming out one way or another. I'm just trying to present both sides to this. And it's kind of beyond the scope of what I do to debate this or really take, I just want to throw in there what I'm hearing going back and forth in the markets itself. And you can make a case for either side. What we want to do is look at both sides, respect both sides, and then say, okay, how is that going to impact the stock market? That's where we come out. So, but what are some comments from Friday? The technicals are still positive, but are showing some signs of weakness. Some of them are not. Some are still doing okay, but we're starting to see it's getting a little not as positive as it was a few days ago. Of course, we have Russia, Ukraine, inflation. I've already mentioned all of the different things that the market is trying to deal with right now, and we're trying to deal with on a personal level as well. The economic report that came out was pretty good. It was a pretty healthy report, and it gives support to this idea that rate hikes can continue. Well, on one side, you've got some suggestions that the economy may really be slowing down. On the other hand, you've got reports that say we need to raise interest rates because of inflation. And so the Fed is caught in this balancing act between maintaining control of inflation without weakening the US economy. And it's never been done in the past. They talk about this soft landing that seems to be this elusive thing that they always try for, but are never quite able to get. And we have a very complicated economy. And to just put it into very simple terms is very hard to do. And just one or two little things in one part can really complicate other parts of the overall machine. Okay, now I'm just switching over as far as market valuation to a fairly valued stance right now. Now that March is finished and we're kind of done with earnings season, and then the reports will be coming out about earnings, we'll get a better look at the P&E ratio looking back. We'll also be able to look forward. And once I get all that information, I plan on doing my own analysis of current market valuation. In the meantime, I'm just going to go with what they say on the website, currentmarketvaluation.com. I'm not going to show you anything from that site this time because there hasn't been any updates since the last time I talked about it. But feel free to check that out. They've got some good tools there, and you might find them useful to you. Our trend is positive. We have the green line on top, but it's starting to weaken. And so we're starting to drop a little bit. It's picking up this slowdown in volume, this slowdown in buying. And now we're kind of looking at, and I'll get to this at the end of the video, our different scenarios where are we going to get into a sideways, trendless, choppier, without all the wild swings type market? Because we had really overall, even though we had an up day, if you look at it internally, it looked weaker than it was. The only thing that saved the closing price was that late day buying that came in. So overall, we're still looking more negative overall. And I've switched our momentum to mixed right now, where we had been doing really well, just going higher, higher, higher. Nobody believed it. And that was part of the reason we were going higher. Well, now people are starting to buy into this, that okay, the market is rising. And wouldn't you know, that's about the time it stalled out. And now we're going sideways to down and showing a little bit more weakness at the current time. So we're still kind of mixed overall. Let's go through and look at the day's sentiment. We're right about in the middle as far as how people feel. Not extreme fearful, not extreme greed right now. 50 would be an absolute middle point here. And here's our chart, just showing that we're midway right now. Then the VIX, which had advanced a little bit on Thursday, actually declined and is slightly under 20 right now on a closing basis. And we saw a pretty small bar. So for as big of a day as it should have been, you had the employment report, you've got all these geopolitical things happening, you've got earnings coming out. Didn't really seem to be all that impactful of a day. Then our VIX of the VIX is kind of treading more sideways, although it did increase slightly on a closing basis. Then the UA, we're still below. This is the Ulcer Index. As long as we're below this moving average, we really don't pay attention to it. And then one thing that did come out, and I talked about this in yesterday's video, is the American Association for Individual Investors. They're now coming up to more of a neutral stance, where they had been extremely pessimistic about things. Well, they're more neutral now. And then this comes out actually a few days before my chart seems to update. The bull-bear ratio, the RIDEX bear funds divided by the bull funds, they're back down around to more of a normal reading after having spiked when we were really dropping lower. And that's to be expected. When you see this go up, that means an increase in fear. Well, now that we've been climbing up out of that, you're seeing that fear really wear off, which is what our other indicators are also telling us. Also, a thing that came out in this week is these are active money managers. These are like mutual funds. Instead of having a passive mutual fund that's attached to the S&P or some kind of an index where you don't have to choose what stocks make up that mutual fund, these are mutual fund managers and money managers who actually go out and look, and even hedge funds to a degree, that they tell us what they're doing. And when this line is declining, that means they're getting out of their more risky assets that give you the better returns when they're right, and getting more into defensive type investments. Well, we hit a bottom. We've been coming back out of that, and now we're about in the neutral range as far as getting back into the riskier assets, risk versus reward. When there's less risk, they jump into a lot of stocks and to see those higher returns. As far as our sectors, we had 8 out of 11 were positive, with real estate, which has been getting hit pretty hard lately. Let's see, the 3 that were down: financial, tech, and industrial. So banks are kind of having some trouble right now with all of the interest rate issues that are going on. Tech has been having some problems lately, but has been trying to come back. And then the industrials is more of a value play. And this is just going back to the high. Energy is still doing the best. Discretionary has gone back into last place, followed closely by communications, and then tech as well. And then this is just the tech sector. We want to keep a close eye on this since it's a huge part of the growth versus value battle that we talk about. We declined 0.3% on Friday, but we're still above the moving average. Inflation, and I don't have a lot of charts on this one because not a lot has changed. It's just kind of a continuation of the inflation situation that we've been in. The CRB actually declined a little bit, but is still in an overall uptrend. Then some newer charts are that I take the CRB and then I do a ratio to the S&P. Well, for a long time, this shows that the CRB was underperforming stocks. Well, into 2022, with inflation rising, we're seeing the CRB really outperform, even though it is falling back, but it's still above this moving average. This next chart is just the exact opposite. This is taking the S&P 500, which had been going up and up and up and up and up, and then we hit 2022, and now it's going down as the CRB advances. Well, it's still in an overall downtrend, but it was up a little over 1% on Friday with this ratio. This is another chart. It updates once a week. This is fertilizer, and this is kind of the basis. I mean, there's a lot of things you could look at the basis for inflation, but this is where things that grow in the ground, it all starts here. And so if fertilizer prices are really going up, that's just going to be the beginning of a whole chain of events that lead to more inflationary pressures all along the way that will finally make their way to us. And we're getting pretty high. And just to make a note of this, the last time we saw a real spike in fertilizer prices was there was some kind of a financial crisis thing that went on for a while. Again, this doesn't necessarily look like it's topping out right now. And it could continue to go much higher than it is. Then technical alerts, they were mostly negative, except for Canada. They're doing okay. They were over 22,000, but most of these were negative. Oil, well, that could be positive from a consumer standpoint. We got below, we're just barely below 100 right now. Then we saw here in Canada, they had a bearish MACD crossover. And then the Nasdaq fell below 14.2. Then you had a few of the sectors that had been going up. Well, they're starting to wear off some of the extreme positive readings that we've been seeing. Here's the intraday look, where this was the massive sell-off that we saw going into Thursday's close. Well, it wasn't really hard to have a positive open on Friday. But right after we opened, boom, we started going down and we actually went negative. We tried to bounce up out of that. Wasn't going to happen. Went negative again, and then made it all the way down to S1. Bounced around here for a little bit. It looked like, okay, the market was okay with that being a support. And then we saw some buying come in, actually went back positive, but then we saw some more late day selling. Not to be outdone, in the last 20 minutes or so, we saw some buying here. And then in the last 10 minutes, boom, we saw a real increase in buying. So if you had not had this last 10 minutes, which I'm not trying to discount that because that's a real thing, but we were much more negative on the day than what being up 1/3% would really indicate. And our indicators are picking up some of that. And it's making things look a little more negative right now. Here's the daily chart where we came right up to this resistance level. We've been coming down off of that. The question that we're asking is, are we just falling back a little bit before we regroup and get ready to go higher? Or are we starting to see a reversal here? And we don't know. And to try to take a stance either way right now, you just can't do that. We can use our tools to measure things and come to a logical conclusion based on what we're seeing, but to just be dogmatic and say, oh yeah, we're just going to go straight down from here, or we're just going to fall back a little bit, buy the dip, buy the dip, buy the dip, and then get ready to go higher. And you can make a case for either side. There's plenty of uncertainty out there, which probably would help the bullish side of things because the market likes to climb a wall of worry. We're down 5.23% from the high. Here's the high right here. This is what we look like as of right now, and a whole lot of choppiness in between. It's been a wild ride so far for 2022. Growth saw a decline, value saw an advance on Friday. Then looking at growth, the decline, when we do the ratio between the two indexes, it declined a little bit, although it's been trying to bounce back, but it's still in an overall downtrend. Here's the exact opposite. Value has been in an uptrend, falling back, and it actually advanced a little bit here, but it just shows you that value is really, it shouldn't be taken off the table at this time, even with growth trying to make a comeback right now. Here's the Nasdaq 100 underperformed the S&P 500. That's more of a growth play. The S&P, even though it has a lot of tech stocks, also has a lot of value stocks. Then our peer value index was up 0.20%, even though it's not a real healthy looking chart right now. Here's our growth. It was down 1/3%. So it just shows you the value was slightly more powerful than growth on Friday. And then this is a combination of the two. I don't have any moving averages or anything on this chart yet, but we declined about 1/3%. This is taking growth and then doing a ratio against value. Looking at our trend, this is what we kind of have to keep an eye on here. It looked like our ADX was turning up and our green line was going higher and our red line was going lower. That was looking pretty good. It doesn't look that way now. We're seeing the green line coming down and the red line coming up, and these two lines are getting closer together. So our ADX is starting to drop. We're still at between 23 and 24 overall. It's when we drop below 20. That's when we say we're in a more trendless environment. So we want to keep an eye on that. For things to turn back more positive, we need to see some healthy buying coming back in for this green line to go back up and this red line to either stay the same or decline. That will help turn the ADX back up. Arun also showing a little bit of weakness where we're seeing a declining measurement of buying power, and we're seeing an increase in selling pressure. And so our oscillator still positive. We're still above zero, but declining right now. So this is a little bit of the weakness that's being picked up. No real change on the decision point scorecard. If you watch these videos every day, you can just look at this. I won't read them off to you. Looking at breadth, we saw a little bit of advance based on price, but we're starting to see a little bit more of a breakdown. Even though we were kind of sideways to slightly down on volume, the idea that we came right up to this moving average and bounced back down is causing us a little bit of concern. Now, other times that happened and then things worked its way out and we were able to break above that. Can we do that this time? The advanced decline ratio, after giving us an extreme positive reading earlier in the week, is dropping back down, but is still above zero. So that's still positive overall. New highs, new lows, which had been kind of giving us some real strength here. Well, it looks like we're starting to roll over with our moving averages now. The accumulation distribution, it's still looking pretty good, where we advanced slightly and we're still moving well above the moving average. Short term, we're above our 20 period moving averages. And here's our 20 period moving average study, which after giving us an extreme positive reading has dropped back down and was up ever so slightly. Now that's positive. That's just wearing off an overbought signal. We were more flat when we look at the 50, and we're pretty much flat when we're looking at the 200 as well. Then our spaghetti tree here. I thought it was so cool when we broke through the 100-day moving average. Well, we broke down below it on Thursday, and we're right at the 100-day moving average after our close on Friday. Just a little tiny bit above it right now. MACD still going up, but starting to show weakness. We see the histogram starting to trail off, and the line is starting to roll over a bit. Doesn't mean it has to stay this way. It's just showing some weakness right now. STO is also showing weakness on price and volume. This was another thing that you could probably put more into the positive camp. McClellan Oscillator gave us a really extreme positive reading. Okay, we had our down day or two there, wore that off and saw a little bit more of an advance, and we're still above zero. Then our Stoke RSI, it had been pegged positive coming off of that reading. Williams percent R, pegged positive, dropped a little bit below, and now turned up ever so slightly on Friday. Force Index, also, we're right about here. It's still positive after giving us a pretty healthy reading. We were getting a little bit extreme when it was hitting the Bollinger or the Keltner envelope here. But right now it's looks like it's just wearing off an overbought reading. Intermediate term, we are still above the 50 period moving average. Here's the 100-day, just to slap it back on here, where we're just a little bit above right now. The PMO, still positive, but rolling over just a bit, as well as based on price, and turning over a little bit more based on volume. PMO rising after giving us an extreme positive reading, fell back from that and is coming up a little bit. That could probably be taken as more positive. Those that are generating buy signals are still extreme and rolling over. Possibly a little more negative with that, but it's hard to be negative when you are in extreme positive territory, but so you can take that either way. And we saw a little bit of an advance with those PMOs that are above zero right now. The BPI is still in extreme positive territory and falling back slightly. And then here's the longer term view of that chart. If we drop below 70, that'll be one of the technical alerts that are automatically generated that we look at. Here's our rainbow with us coming back down a little bit into the upper part of the rainbow. Stochastics, shorter term, we saw a decline with the slight upward move that is we're right about at the extreme positive territory. More intermediate term are still wearing off, more of an overbought reading. Our full stochastics are starting to potentially cross over negative right now, but from an extreme positive reading. Then I haven't shown this in a while, the Sean trend meter. We had gotten up into this ugly green area. Well, we dropped back down into this kind of constipated yellow area right here. Then with the summation index still advancing based on price, but we're rolling over a bit based on volume. That's actually starting to turn down. Want to keep an eye on that. Sometimes this indicator will actually lead prices. Our momentum oscillators are still positive, but some of them are starting to roll over slightly. Vortex showed a little bit of an advance based on buying and pretty much flat with the selling. That's positive overall. RSI just ticked up ever so slightly, is above 50 and not giving us any kind of an extreme reading right now. The CCI, the shorter term one that I look at, it's coming off of an overbought reading, as is the 20 period, also coming off of an overbought reading. The Sean oscillator, it had been extremely positive. It's wearing off that overbought signal. And so this is part of the debate right now. Are we looking at reversing, or are we still working off the overbought situation that we've been in? The Chaikin money flow is still positive and actually advanced a little bit on Friday. And the ultimate oscillator, which had been extreme positive, dropped back down. Now we're back up into extreme positive territory again. And then our itchy and scratchy cloud here, it is still giving us some level of support right now. I'm not a big user of these charts. I just kind of look at them when I feel that we're, and talk about them when I feel like they're saying something to us. Well, when we broke through this, I thought, that's kind of cool. I better talk about that. Now that we're coming back down, this could be acting as support. Different trading systems. Elder is now neutral. And here's the SPY, which is also neutral. SAR is still positive. Our different charts, Heiken Ashi, we're seeing a couple of dark candles now, but we're still looking at a pretty healthy overall move up. The Kegi is still positive because it's black, but is actually, this line got a little bit bigger here. Renko is still positive. Three-line break is also still positive. Equi-volume, we're starting to, again, we're looking more at the formation here. We see a lot of green candles on the way up. Are we going to see more red candles and go lower, or are we going to be able to turn back up from here? Whoops. And no new signal with the point and figure. We're still coming off what they're saying is a double top breakout. But because we haven't really broke out any more than we already have, no new X's have been drawn. Long term, we are still above the long-term moving average. So that is positive, to be above the 200-day. And here's the logarithmic view as well. That will help the long-term prospects any amount of time that we can stay above that moving average. The big stocks, they were up 0.13%. We hit some overhead resistance at the 200-day moving average, and we've been coming back down ever since then, even though we saw a little bit of an advance on Friday. These are the mega stocks. It's kind of another alternative to the FANG index. Looking at our special K, it's still going up, but flattening out a little bit. And then here's the longer term chart. Then our moving average study that looks at longer moving averages. Again, you could take this as positive. We were extreme positive, coming back down. We went a little sideways on Friday, but we could just be wearing off an overbought reading. Looking at our 150, we were pretty much flat. And we saw a little bit of a decline with the 200-day moving averages. Looking at some other markets, here is the S&P, here is the mid caps, kind of showing a very similar pattern between, not, well, a lot more related pattern here, but then what we're seeing with the small caps, they're still kind of more in the range that they've been in for quite a while. And then here's the Dow Jones Composite, again, taking the Dow, the trannies, and the utilities, cramming them all together and coming up with an average or a composite index. It was down 0.92% currently. And I had some different moving averages on here before. I've changed that up right now. So we're dealing with what could be a recent death cross. Here's the FANG index. It was up 0.77%. And here's ARC, up 1.89%, trying to get above this 50-period moving average. And we're seeing a real gap between the 200 and the 50 right here. And that means we've fallen pretty far, pretty fast with ARC. The Dow, after getting above the 200-day moving average, has now spent the last 2 days closing below the 200-day moving average. And here's the diamonds. We're back to neutral. Here's small caps. After just getting above the 200-day moving average for 1 day, has now spent the last 3 days below the moving average. And we came down to this pivot level and we're able to bounce up off of that. So that could be slightly positive. Mid caps also look like we were getting above the 200-day moving average, only to lose that. Nasdaq never even got up to its 200-day moving average, but still had been seeing a pretty hefty advance. We still had an up day, but I'm not quite sure what to really make from this other than we're still below the 200-day moving average, but we're above the 50. Nasdaq 100, we were able to break above the 200, but then we've lost that. The Vixen, as prices are going down, we're actually seeing the Vixen decline as well. Isn't that interesting? They usually move in opposite directions. So this could be seen as positive. We're not seeing a lot of additional hedging going on in the Nasdaq 100, even as prices fall. Now, we had an up day, so that might give us a little bit of an illusionary type of pattern here, but that's just kind of interesting how that worked out. And then here's the Qs. They are more neutral now. NYSE, this is positive. We're still above the 200-day moving average. It's a broad-based index. And then here's the S&P 100 underperforming the S&P 500. The big stocks are going down faster than the smaller stocks. The Wilshire, this is negative. When I look at the NYSE, we're above the 200-day moving average. When we look at the Wilshire, we've dropped below the 200-day moving average. Internationally, we're still trying to show a bit of a bounce here. And then looking at all stocks, after hitting that overhead resistance, we fell back, even though we bounced a little bit on Friday. Then taking out US stocks, they were down over 1% on Friday. Looking at the broad market, here's the intermarket analysis, which just shows going back 1 year, oil is up, what, 83%? Yeah, 83%. Here's the S&P, the black line. Here's gold, how it's been performing over the last year. The blue line, or excuse me, the green line is the dollar, and the blue line are the price of bonds, not interest rates. They're the prices of bonds. And the dollar, which got hit a little harder earlier in the week, was up 0.25% for the day. And then on the weekly chart, it's still showing a pretty strong upward trend. Oil, just below 100 right now. Gold, down 1.5% overall. This is the futures contract right here. And then with the ETF, we were down 0.64. But we're still above this moving average after seeing a recent golden cross. But my goodness, if you've been just whipped all around, if you try to get into gold on a trending type basis. It's a wild ride. And here's a longer term look at the ETF. Then this is kind of an interesting chart. Feel free to pause this and look this over. This is gold up here. This is the futures contract. It's not the ETF. And if you want to just look at this and then look down here, here's the 2 to 10 year spread. What happened when we went inverted? What happened after that to gold? And if you want to look all the way down here, I have the 10 to the 3 month, the 30 to the 5 year spread, the 10 to the 5 year spread, the 10 year to the Fed funds rate spread. And you see that most of these are going down right now, but we have the 10 to the 3 month actually going up, and we have the 10 to the Fed funds rate actually going up as well. That's what a lot of the debate is about right now. Are we heading for a recession or not? Well, part of our yield curves are going down and going inverted, and other parts of our yield curve are actually going up, which that shows economic strength. What are we going to believe right now? I also have another chart of this with the S&P at the top. So here's silver, which is, it was down almost 2/3%, but still coming off of a recent golden cross, but you're just getting bucked all around with that. Longer term view of the ETF. Then Bitcoin kind of spent some time in the upper 40s. Now it's more down into the mid 40s. We'll see how things go over the weekend. We haven't seen enough of an advance yet to really say, is this the left shoulder? Is this the head? Is there still another right shoulder somewhere up here to be formed? Pure speculation at this point, but just something to be aware of. Bonds, we have now gone inverted with the 10 to 2 yield curve. We have gone inverted with the 10 to 5 yield curve. We have gone inverted with the 30 to 5 year yield curve. But when you look at the 10 to 3 month, we are advancing right now. And then I've got these in the wrong place here. And then this is just the Fib retracements. We're right at about the 50% retracement with the 30-year yield. Then this is the one that Edward Yardeni really recommends that people watch. It's the 10-year to the Fed funds rate. And this can get a little out of whack because these things don't change all the time, but this shows that we are currently advancing. But this is a little bit delayed right now. Notice you see over here, February 1st. So we have to be a little bit suspicious of this chart, but overall, it's still showing that we are advancing. But the data for this can be somewhat lagging. And then this is the S&P on the top with all the different yield curves down below. So if you want to stop, pause the video, look at this, and then see after we went inverted, what happened to stocks overall? And do we see, if one yield curve inverts, are we seeing other yield curves invert at the same time? Typically, yes. And then typically after we go inverted, we see a really nice run up in the markets. And then we hit a recessionary type of an environment or some kind of economic slowdown, which to this point has usually been recession. Then looking at our yields across the board, we saw a real spike up in US yields, the 30, and they're just dancing over here. And we saw a bit of an increase with the 3 month as well. So this is all getting jumbled up together. This just shows that there's a lot of confusion right now. They're worried about the short-term yields because of inflation, and then they're worried about the longer-term yields because of a lack of potential growth. And so, okay, that's really kind of messing with folks right now. And we're having to shift from the scenario that the markets have been used to for quite some time. Internationally, also showing how rates overall are advancing, even though we saw a bit of a decline in the past week. Then this is based on price. This is a bond index where we're getting right down here to what had been previous low levels. Are we going to be able to bounce up off of that? If we do bounce, that means interest rates will go down. If we fall down below this, that means that interest rates will still continue to go higher. And corporate bonds, little bit of a weakness on Friday. And here's the overall bond yield, 3.38%. And this seems to gyrate all over the place. But I go to the Fed site. This is Fed information here, but sometimes it's a little outdated. Then junk bonds were actually down about 0.25% and still below the moving average. Again, when people don't mind taking on riskier investments, they might look at getting into junk bonds to get those returns. Well, since the beginning of 2022, we've been going down in the stock market, so people aren't as enticed into junk bonds. Then here's another chart that I show periodically. This just shows the 2-year yield. And at other times when we've spiked, that usually marks some kind of a top in the market. If you look back here, this is 2000. There was the dot-com boom and bust. Here, and I'll probably end up showing this in the weekly chart as well. Here, when we topped out in the 2-year yield, this was the top of the market, and then we had the financial crisis after that. This was the Christmas Eve mini meltdown that we saw back in 2018. Well, we've still been spiking right now without it really rolling over at this point. And so we keep an eye on this. And again, this isn't something that we can really use in real time, because we only know in hindsight that this was a spike. It might look like things are starting to roll over, and we might say, oh yeah, here we go, this is it, baby, only to have it go back and set another high. So because these things don't move up and down in a straight line, we just want to be aware of this and make this as part of our overall decision-making process. Now, looking at some relative markets, here's gold against the S&P. It had been breaking out, but now continues to break down. Oops, I went too far. Here's energy against the S&P. Had been breaking out and continues to break out. So it's been really outperforming the rest of the S&P. Here is growth against bonds, where we saw growth stocks against bonds. We saw a decrease on Friday. And then here is the tech sector against the SPY. We came right up to this moving average and bounced down slightly. And here is tech against the 10-year. Remember, a lot of these companies have to borrow money, and if they have to pay higher interest rates, that's going to eat into their profits. So as interest rates go up, we start to see tech stocks go down. As interest rates go up, overall, we see interest rates outperforming tech stocks. That's just an inverse of the previous chart. Here we look at discretionary against staples, where discretionary has seen some recent weakness. That's why it's now back in last place in our sectors. This is another newer chart that I was just looking at this the other day going, my gosh, look at this. When you compare the staples, the things that you have to have with the S&P, when this tops out, a lot of times that means a bottom in the market. And this is not scientific. I just eyeballed all these different lines that I put on here, but feel free to look at this. If there's some significant thing that I missed, feel free to let me know. We saw a kind of a spike in staples back here. Well, that was when we hit the bottom that we're coming up out of now. And currently we are now declining, even though we saw a little bit of an advance. And I have a shorter term view. This is just going back, I think, 5 years here. And I could even make a smaller chart because I want to try to get on top of this better. So again, we can't really use this to make decisions because we don't really know without looking in hindsight. Oh, that was it. That was it. What we do is when we see things behaving a certain way, and they actually spiked up a little bit on Friday, we just put that on our back burner, so to speak, and might use it as part of our decision-making process, because it's really, really hard to use this as an indicator, because you'll get faked out a lot. It really has the potential of generating a lot of false signals. Then looking at the S&P against the 10-year, well, the S&P has really been underperforming the rise in interest rates. And then here's the low volatility stocks. And these are the stocks that people tend to get into when they're more defensive. Well, we saw that up over 1% on Friday. And then to compare the low volatility stocks with the SPY, this just shows where the SPY had really been outperforming low volatility stocks until we got into 2022. And now we're starting to see the low volatility stocks outperform the SPY. So let me make sure. Okay, yeah. So what is our outlook then for Monday? We're still asking some questions to play out some different scenarios. Are the short-term overbought readings just wearing off? The technicals are weakening. Are we looking to reverse, or are we just getting a little bit weaker and going a little bit lower before we're getting set to go higher? That's kind of the question on the table right now. The market does remain in that intermediate term range. There's still the daily growth going, or daily battle going on between growth and value. A lot of yield curve concerns, probably going to see a lot of videos, read a lot of articles. Everybody has an opinion. My take on that, and I do have a video that I posted a few days ago, if you want to go back and watch that, is just know that they're there, but avoid getting real dogmatic about where you stand with all of this, or listening to somebody that you might really trust and take their conclusion as your conclusion. Don't be afraid to come up with your own conclusion and just sort through this and say, okay, yeah, we're getting a real mixed picture right now. And so if we go higher, this is what I'm going to do. If we go lower, this is what I'm going to do. If we go sideways, this is what I'm going to do. That's what true success is in the market. Not listening to other people. It's developing the tools to come to your own conclusions. Okay. Then we have the oil supply issues that are going out. Is that a good thing? Is that a bad thing? Is it going to really affect oil prices in the long term? Is that going to hurt the US more long term? That's the debate going back and forth. On Monday, we do have factory orders coming out. Not a real big employment report, but still something worth to pay attention to. And then along the bottom, you can see the different geopolitical events that the world has to try to digest and make sense of at the same time. So what are our scenarios? Negative. Okay, we're still looking at one possibility. If we go down from here, that we're still working off that overbought situation. Now, we've kind of worked that off. There are some other indicators that are still extreme positive, but if it goes much further than that, this scenario might not seem as likely. So are the recent declines a reversal? If we keep going lower, it might look like that. Or are they just to wear off a short-term overbought condition? That still seems to be in the lead right now after looking at our charts. But we want to keep an eye on this. If we really start heading lower, we might have to switch this scenario just a little bit to what seems most probable. We want to keep an eye on the rising interest rates and just be aware of the yield curve concerns. As these things go crazy, they may feed over into the stock market. Typically, that means negative. And then there's this battle going back and forth from the bounce that we had. There's a disbelief. No, it's just a dead cat bounce. Well, a dead cat bounce is bouncing pretty high right now. And then it gets to the point where people are like, okay, maybe this is for real. They jump in, boom, now we've stalled, and in fact are looking weaker than we were before. And then will sentiment turn more negative? And you could also, that's if we're going to go down, because right now we're middle point right now. We could go either way with that. Now, looking at the up scenario, we are seeing strength after building that base. Can't deny that. It's right there on the chart to see, even if you didn't plot any indicators there. The oscillators are positive, but could be showing some signs of weakness. We're seeing a few of them start to roll over. The MAs could be providing support, but we also have some resistance now to deal with, getting back over that 100-day. The Dow getting back over the 200-day and so forth. And then the battle going back. Can you believe this? Can you not believe this? With the up scenario. And then this is looking a little more likely right now. Is this neutral sideways pattern? Because we're seeing the ADX decline. And if it drops below 20, that's going to push us more into a sideways trendless market where price movement typically is slower during those times. And that's when you might look at implementing some kind of sideways or market neutral type strategies. Okay, what's our conclusion? Overall, the S&P is positive and could be breaking out of a range. Yeah. Short term, we are positive, but we're showing some weakness. Intermediate term, positive. Our oscillators are still positive, but could be showing signs of weakness. The moving averages, if they're below where we're at right now, they could be providing support. If they're above where we're at right now, they could be providing resistance. Then long term, we still remain positive because we are above the 200-day simple moving average. Then one thing to be aware of is I know most people watch these videos on the weekends, and I understand that. You have a life, you have but there are lots of other videos that I put out there. I try to put out what's called a daily snapshot video because I know these videos can go on for a while, but I don't care. People say your videos are too long. I don't care. I need to say the things that I need to say to help you the way I want to help you. That's where I come out. And sometimes it takes longer to talk about those things. So what I try to do is make a pared down, usually about 10 minutes long, snapshot video. You can come and watch that and then say, okay, now I'm going to go watch the full daily video, or just say, no, I don't really need to watch the daily video today. I've got enough from this. I'm not really making any decisions right now, either to get in or get out. So I don't really need that. Also, over the weekend, I plan on preparing a weekly video. And then because we just finished up with the month of March, my goal, and again, this is a goal. This doesn't mean this is going to happen. I will be preparing a monthly video, and I've done that before. But there are some newer videos that I haven't put out in a while. One where I go back and look over the economy. I'll go through one on the different sectors, and then I'll also look at international indexes just to get an idea of where do we stand with things right now. This is a much more big picture type of look. So I hope those videos will be helpful to you. I enjoy making them, but they take a lot of time and a lot of effort. But I really get a kick out of it, especially when people find value in what I'm doing. Okay, so thank you very much. Have a great weekend. I will be preparing these other videos I just talked about, and I'll prepare the next daily video after the market closes on Monday.